Then they prop up that old hag yesterday in front of Congress. It was such a disaster.
Talking about old Yeller, my ex-girlfriend.
Yeah. Yeah, if you look at the combined ages of these people that are leading this country, we're talking over 1,000 years old.
Yeah, you dropped that
I just
bitch
almost
off.
spit out my coffee, man.
Just
You're
in
not
time,
lying.
boss.
What's that?
You dropped that bitch off just in time, boss. She's not looking good.
Old Yeller's
She's starting to deteriorate.
She's taking a fucking beating over the last year. You see how like different she looks just
Yeah,
like in the last
she's
12 months?
deteriorating.
Oh shit, man!
That's good, hilarious.
Funny.
Oh, she looks like shit in that fucking Congress interview yesterday.
Yeah.
Just looking
I
at
mean,
the one
she
from
didn't
September.
look. She wasn't a looker, but she looked better. Back when you
I
were
didn't know Danny
were an item.
DeVito could get any uglier.
Oh shit! I got these dudes in my house redoing.
Yo, Pete. Yo, I just went live, brother, so I don't want you to give away any personal information, okay?
All right, I'm out of here. I'm gonna go.
Oh, you don't have to go. I just wanted to give you the heads up, man. I didn't want you to say
No,
anything.
I'm gonna mod this.
My
Get
man.
the fuck out of
Appreciate
here.
you, Pete.
All right.
Diaz, #1 mod. Thank you very much to all the mods.
Don't tell
Pete,
Pam.
Javi, Pam, all you guys. Thank you guys. So much love.
All right, bro.
Oh, man. Sean PA, we got to have a talk, brother. You said MMTLP this week, more AMC. All right, MMTLP, in my opinion, is not a real stock. I believe it to be OTC bullshit. I believe MMTLP holders will get caught left holding a bag. My man on the Discord, Exact Perspectives, has been showing me weeks and weeks worth of due diligence that he's been doing on MMTLP. Now, that is not the same as MMAT. I am very bullish on MMAT. As a matter of fact, I bought some fucking calls yesterday on MMAT. But let me bring this up here because we need to have a talk. Guys, MMT
while you're doing that,
is not the same as MMAT. Remember that. Go ahead, brother. Don't worry. You can jump in. Glizzy, what's good? All right, Glizzy went silent on me. What the fuck, bro?
Say what?
I don't know. I thought Glizzy had something to say.
Bad.
There
My
you go.
bad. What's good?
What's cracking, brother? What's happening? Must be having some reception issues. That's all right.
how come they won't let AMC go to SSR?
What do you mean go to SSR?
The short sale restriction,
Oh, they don't
right
want
before
MM
10%.
Oh, Ninja, they don't want it to go onto the SSR list. Now, what the SSR short sale restriction list prevents market makers and hedge funds from shorting a stock when it's going down. That only allows them to short a stock when it's going up on the uptick. It's called the uptick rule. But what people need to understand is that doesn't fucking make a difference. The SSR does not actually prohibit them from making those trades. It's just one of those regulatory things where they're not supposed to short a stock if it's on the way down and not in an uptick. But that hasn't stopped market makers whatsoever. So to be honest with you, yeah, I don't look into things like the SSR rule as helping AMC or GameStop really in any way. You know, maybe slightly, but it doesn't really make a difference. However, you do make a good point in the sense that it seems as if they don't want it to be on the SSR list because then it will give more people the idea and the verification that it is heavily shorted. Therefore, when we saw the price drop from $34 last week down to $29, that kept us 1 penny away from reaching that down limit on that would put AMC in the SSR list. Therefore, it did not go on the you know, on the short sale restriction list last week, and they were able to continue to keep shorting the stock down. Does that make sense? And it's more of like,
Well, and
Yeah,
Go ahead.
definitely.
Go ahead. Sorry.
if history
Brother, your reception's kind of shit right now, so I can't hear anything, to be honest with you. Just so you know, I'm not trying to be rude, but just giving you a heads up.
I got you. The push to talk keeps cutting out.
Yeah.
I was just gonna say that if history repeats itself, it hasn't done a whole lot in the past, but now the DOJ investigating, I wonder if they're a little bit more careful about trying to break that rule. Because for all of us that have been in this for a long time, SSR hasn't done anything when it should have. And then now, hopefully, they're just having to be more careful. So maybe they're trying not to touch it as hard.
Yeah, dude. SSR literally just stops bad actors and nefarious short sellers from piling the fuck on. That's all it does, because you're going to see a massive uptick in short exempt volume if SSR gets triggered. That's all it's going to do is these market makers are going to use their fucking special titles to maneuver around SSR anyways. It's a big deal. Or not a big deal.
You're right. It's not as big a deal as most people make it out to be, you know.
Yeah.
Let's see if we can give a quick share of this thing out over on Twitter, since I have not bothered sharing it. I appreciate all of you for showing up and coming out, hanging out with us on this live stream. You know what? Let's go through some questions here. You know, Boom Boom Power says, "Yo, brother, I hope you and your family are well and strong. Thank you. Yours as well. The whole market is a joke. It makes you wonder how corrupt greater society governments are." Oh, brother. The corruption is rampant. It is real. And the only way we're going to be able to do anything about it is by making real change. Guys like Dave Lauer and Unusual Whales coming out with new platforms for us, educational tools. You know, so that's what we're doing as well here with Xchange. You know, trying to make a broker-dealer that does not use payment for order flow and dark pools that distort price discovery and suppression. Xchange, 100% lit markets, coming Q4 2022. We'll talk more about that in the future once I can release some more information. But these are the kinds of things that we need to do as business owners, as entrepreneurs, to try to make real change in the stock market. Why? Because we can make fucking change. And as investors, we can make change as well. How? By buying, by holding, and by beating these pricks at their own game. All right, cool, Martin. I'll catch you later, brother. Oh, I see. There you go. You got a good question here. Where was that one at? I lost it. I got to go to all, not just mine. Oh, there it is. Big Shack. What do you make of this portfolio? Short semis, long silver, SLV, long STIP, short EFA. I can't give you financial advice, brother. I like SLV, but I do worry about the manipulation. So the one thing I will say is, for me personally, since I own some SLV, I plan to get out before the silver squeeze gets out of control. Because we've all seen the government here in the United States in the past, as well as all around the world, force people to give them their precious metals such as gold and silver. And the manipulation on the precious metals markets is real, and it's much more intense than even what you know is going on in AMC and GameStop. Like, we are aware of everything that's happening with these stocks and how heavily shorted they are. But are you aware of the level of shorting and manipulation that's happening on silver and gold and all these other precious metals? Probably not. That's what makes this the everything squeeze. That's what makes this the everything squeeze. Some very, very heavily manipulated, Stocks are going to go to the fucking moon. Meanwhile, Congress and the Fed are selling off all their fucking blue chips before they go to shit, and have even forced themselves to sell some of their positions. And they told us they were doing it because of ethics. We've heard that before, huh? Sure fucking have. Remember when they told us inflation was transitory? I remember that. And I remember in July of 2021, we were all right here on this stream discussing how inflation is not fucking transitory. Here we are now with nearly 9% inflation rate. When if calculated the same as it was back in the 1990s, it would be closer to 16%. Check it out. Check it out. My man Darren Harper on Twitter posts this. It's actually a really good point here of the Treasury securities sold by the Federal Reserve in the temporary open market. Here you see the intervention of the Fed right about here. And ever since, the amount of Treasury securities that are being purchased in the United States reverse repurchase program by the Federal Reserve has skyrocketed and will continue to shoot upwards. And it will be at its highest at the end of every quarter. Just like at the end of the third quarter, March 31st, I believe it was, 2022, we saw the second all-time high on the RRP program at $1.89 trillion. The all-time high was on December 31st of 2021 because the banks had to cook the books to make sure that everything balanced out. And that was at 1.90 something trillion from there. There may be temporary pullbacks like there was here after the 2020 liquidity crisis, but it's going to continue to shoot upwards until the market actually does have a proper pullback and collapse. These right here are securities held outright by the United States Treasury securities. Look at the number of, by the banks of these United States Treasury securities. 6 million millions. That means $6 trillion for those of you that don't feel like busting out the calculator. 6 trillion. Crazy. Crazy amounts of liquidity have been pumped into these markets. Now where the fuck did we go? Yeah, that one's from yesterday. Again, in case you didn't see yesterday's, credit default swaps for Russia and Ukraine were trading between $500 and $800 just in the middle of February. They're now trading at $2,360. That's about a 5x move on the cost of credit default swaps. Those are hedges against mortgage-backed securities. That means that when mortgage-backed securities tank into the fucking ground, these credit default swaps are going to make banks and and institutions a shitload of fucking money to hedge against their massive losses in mortgage-backed securities. My man Nick,
Ready?
Thanks so much for posting this. It's really that fucking simple.
Ready?
It's really this fucking simple. You have Archegos, you have Evergrande, you have Chinese developers, junk bonds, Chinese military corporate bonds, and treasury and securities that are going to be made worthless by Biden's executive order that causes them to become worthless on June 3rd, 2022. Boom, motherfucker. That's what's about to happen. Thanks, Nick. Appreciate you for posting that up. Hey, if any of you guys need any solar panels and whatnot over in California, make sure you hit up Nick G at @goats_solar. Evidence. This is price spoofing. Okay, every single one of these trades is set up at $182.79. Look at the size: 1, 100, 55, 128, 500, 67, a shitload all placed within microseconds of each other, within hundredths of a second. Can you place, I don't know, gee, do any of you guys have all those shares to sell? And can you place all those separate orders within 3 milliseconds of each other? Or should I say within 300ths of a second? My apologies, I misspoke. That's a lot of fucking orders to be placed with the quickness. This is price spoofing on AMC right in front of your eyes. I'm sorry, 182, this was GameStop. Thank you very much, Emma. Make sure you guys are checking out at Emma Taylor 590. Thanks for your support. Appreciate you tagging me and showing us the artificial price spoofing that's going on here on these stocks. We've seen it here many times in many instances, and you're going to continue to see it. Now, for those of you that are unaware, jet fuel is at massively high prices. It was at $158 a barrel last week. This week it was up to $760. We can go and check it out at the IATA Jet Fuel Price Monitor. It's a jet fuel price index that provides the data from energy information providers like Platts. So this is still the most recent one here. The index has, as of April 1st, was at 431.80. And take a look at the price action over the last 12 months. What is jet fuel? Jet fuel is basically diesel. For those of you that are unaware, it's pretty much fucking diesel. And look at what's happened here. This, it up being up there over at 440 on March 19th, April 2nd, and is now higher as of April 7th today. This is the reason why more of your flights are being canceled every single day. It's going to keep happening over and over. So, the ruble, according to our boy, President Biden, said that the Russian economy was on track to be cut in half. And that supposedly, soon, it would not even rank among the top 20. This dipshit thought it'd be a good idea to sanction Russia for the issues in Ukraine. And while many people may support that, that's fine. That's not what this is about. The point is that Biden's making all the wrong moves at the wrong times. 2 weeks later, things look a little different, as the Russian currency soared higher against the US dollar. Now at its strongest against the motherfucking greenback in 2 months. Putin is going to be doing the greenback boogie real soon. When Putin brought the ruble back to the gold standard, it created a situation in which the United States dollar, oil, the ruble, and gold all became kind of stuck together. At this point, if the ruble tanks, the US dollar will as well. And if the US dollar tanks, so will the ruble. If you don't understand why, it's kind of hard to explain, but it's basically due to the fact that the ruble is worth a certain number of, 5,000 rubles is now worth 1 ounce of gold. That means that its price is stable, and they've brought back the gold standard. That's about as more plainly as I can put it. That is the number one thing that should be done in the current fiat to give it some sort of value, but that's not happening here in the States. The main drivers appear to be Putin's rubles for gas ultimatums, and the fact that, as Mike Shedlock, I believe he's from JP Morgan, noted, that much lauded sanctions against Russia are in fact quote-unquote half-assed. Damn, I couldn't have said that better myself. And they have done little to reduce inbound cash flows for energy and agricultural products. Check this out. Bloomberg Economics expects Russia will earn nearly $321 billion from energy exports this year, an increase of over 33% from 2021. 33% more money for Russia. Hey, does it sound like Biden's bullshit sanctions are working? You tell me. The single biggest driver of Russia's current account surplus continues to look solid. IIF economists said in a report that substantial inflows of hard currency into Russia look set to continue. Inflows, money going in, easy. Hard currencies, rubles, euros, US dollars. But if they're for gas payments, remember gas and oil, it's not just liquid oil. It's the gaseous substance, natural gas, and the solid form, coal. Not to mention diesel. These are all oil products. And Russia is getting paid handsomely for it in the ruble, which is now backed by the gold standard. And well, guess what's not? The United States petrodollar. It's linked loosely to the price of oil. And the Iran deal is a bunch of bullshit. It's never going to happen. Trey Spider asks, so what other types of sanctions should the USA have placed on Russia? My man, the United States has no sanctions that can hurt Russia more than they'll hurt you and I. None. Not one. Not anymore. Even without energy sales, Russia's oil exports and output are already falling, supposedly, but guess where that's going? It's going to China. Easy stuff. China's buying it at a small discount, and Russia's still making 33% more than they were making last year. Ain't it funny how that works? If energy prices remain high and major importers of Russian energy and commodities continue to purchase, the current account should stay in surplus. That means they're going to keep making buku bucks. Does it sound like Russia's going to default on their fucking bills? Absolutely not. Just yesterday, Russia had to make a bond payment. They paid that shit. They didn't default like Biden's telling you they're going to. The Russian people aren't really feeling this as badly as Biden wants you to believe. Sure, McDonald's and Burger King closed down. And Putin and Russia nationalized them, reopened all the chains, and they're serving fresh, homegrown beef and vegetables and potatoes and french fries. It probably tastes a lot better than the crap that we get at McDonald's and Burger King that's full of soy and animal byproducts and GMO. Ain't it funny the way things work out? Let's see. My guy Mike McFall, who is extremely out of fucking touch. Let me see here. Says the ruble is not recovered, is being artificially supported by government interventions, especially currency controls. Economists, I trust, estimate that the real exchange rate is 200 rubles to the dollar. And none other than U.S. Treasury Secretary Janet Yellen quickly jumped into rubbish the market's comeback here, claiming that the market for rubles has become so manipulated by actions of Russia, government and central bank to limit capital outflows that you should not infer anything from the value of the ruble. Wait a minute. So how come the Russians can't prop up their stock market with their plunge protection team and prop up their fucking dollar by pegging the ruble to gold and bringing back the gold standard, but the United States doesn't have to? Does that make any sense? Why a real piece of paper that's worth a certain amount of gold, that has real backing, why should it have less value than our United States dollar that is pegged to absolutely fucking nothing but derivative bullshit? Does that make sense? Absolutely not. So what do they economists say? Sanctions have become a moving target and will require adjustments over time to remain effective. They haven't been effective at all. Russia was removed off the SWIFT system. They went to China's CIPS payment system. No problem. America doesn't want to do business with Russia. India is glad to do business with Russia and buy their oil and gas. So is China. And make trades in rubles, and Indian currency, and Chinese yuan, and RMB, renminbi. There's all sorts of things that they can do, and the globalization that we've come to like and become accustomed to is over. It is over. Do you understand? I know you don't see it yet, and you don't have to believe me if you don't want to. Oh, it's my other one. I'll be out there in a minute. Penny, come here, girl. Come here, girl. Come here. Come on. Come on up here. Don't yell. Don't bark. The ruble's actually going to do better. And you can't say the same for the United States. They should link and kind of hang out in the same place for the most part, as far as the same value. But the ruble has a better chance of standing out as a fiat currency than the United States dollar in the long term. Don't get me wrong. I'm not saying that it's taking over. Don't flip your fucking lid. It's that I'm anti-American or anything like that. I'm just saying that the ruble has real backing. Oh, look, I hadn't even read this article yet. That's funny. However, all the time, China, India, and much of Europe is still buying Putin's energy and agricultural products. No matter how loud the threats come from Washington, the ruble will stave off the rubble narrative. Additionally, Russian Finance Minister Anton Siluanov noted this morning, April 7th, 2022, that Russia will do everything to ensure its creditors receive debt payments and is working on measures to reduce ruble volatility and to make the ruble exchange rate more predictable. Why? If you've ever seen Game of Thrones, you know it's because a Lannister always pays his debts. New York, sorry if that's not my attorney, I don't care who the fuck it is, they can wait. Herman says the fiat's value is backed by your belief that you're not being robbed blind. I think that's a great fucking point. As a matter of fact, that's why also posted this morning, April 7th, by my guy Tyler fucking Durden over at Zero Hedge. Futures slide after the Fed's Bullard sees another 300 basis points in rate hikes. I haven't even read this article either. But guess what? I already know what the fuck it's going to say. Because the writing's on the wall and you can see it every day. I mentioned yesterday Bullard's comments. Check this out. The FOMC minutes laid out the details of the Fed's $1 trillion a year balance sheet runoff. It's actually $1 trillion every 10 months because, in case you're unaware, the United States is going to run off $95 billion a month in Treasury securities and mortgage-backed securities. And that's a fact. Jerome Powell came out and told us, we're going to put this on autopilot. Why autopilot? Because they're not even using a mathematical equation. They're just taking a fucking stab at it. They're throwing a dart at the dartboard from a mile away. And in my opinion, he's doing it while facing the other direction. He's throwing the fucking dart backwards. I should actually pull that up so you can hear how disgusting and stupid the FOMC meeting remarks that made by Jerome Powell were yesterday. It was maddening. I'm going to pull that up. But let me finish this article here. So Bullard is demanding a 50 basis points hikes, which we've heard them say for a long time now. Jerome Powell was saying that we were going to do 25 basis points. And I told you that was absolute bullshit. We need 50 basis point hikes all the way throughout the year, 5 to 7 times, 50 basis points every fucking time, and we need to start now. That's the only way we're going to curb inflation. We need to bring unemployment numbers down. They're saying now the Fed may need to raise interest rates to about 3.5%, no longer their 2% target, to counter inflation that's running far too high. In other words, another 300 to 325 basis points of hikes. Bullard even says, Bullard has got to be the, excuse me, like a perma bull. So for him, it's even in his name. So they saying that by that measure, they could say that the Fed is behind the curve. He said, pointing out what has been patently obvious for a long, long time to everyone except the fucking Fed. Again, we've been talking about this since July of 2021, telling you that inflation is out of control. And in the Bureau of Economic Analysis reports and the Office of the Comptroller of the Currency reports that I showed you back then on Reddit, Twitter, and YouTube, it proved that the government was telling us that inflation was out of fucking control and the gross domestic product of this country will exceed its maximum sustainable capabilities before the end of last year. And it has. They knew about it and they didn't fucking care. Because the Fed wants this inflation to happen. The Fed is pushing for this inflation to happen, and they're purposely letting it go higher so that more of you can lose your fucking jobs, and even more people will lose money on the stock market. They are obsessed with keeping the stock market afloat, but have come to the realization that they have to bring the stock market down a notch. They have to take an axe to the fucking knees in order to curb inflation. That's it. Plain and fucking simple. There's no other answer. Oh, Jesus. Look at this. That's the Fed funds rate in blue compared to inflation. As you can see here, when the Fed funds rate was high, that helped curb CPI year over year in the 80s. That's the doing of Volcker. Jerome Powell wishes he was Paul Volcker. He fucking wishes. He's dying to be him, but he will never be. So here we have it. Fed funds rate at all-time lows from 2009 all the way through 2022. Practically here. It did raise ever so slightly, but was still under 2.5%. Even in 2019, when they were forced to raise it to a certain level, pretty much to bail themselves out of the September 17th, 2019 reverse repurchase program collapse that the Federal Reserve had to step in to prop up, literally. And if you're not aware of that, I'll have to do a whole other video on that if you want. I've done it in the past, but if you don't know what's happening, September 17th, 2019, before COVID, was a complete financial system collapse in which the Federal Reserve had to step into this system that's supposed to run on automatically and bail out the banks because the cost to borrow went from 0.05% up to 11% in one day. And that was about to bankrupt many, many, many institutions here. Therefore, they needed a reason to spend some money. It's unclear if the Fed will be able to hike to 3.5% before the economy implodes, but Bullard will certainly get his wish for one or more 50 basis points rate hikes on the way there. The FOMC minutes that we discussed yesterday revealed that many officials had been of the same mind and only opted for the smaller increase out of caution in light of Russia's invasion of Ukraine. In case you didn't know, Russia's invasion of Ukraine and American support of Ukraine is helping curb inflation because it is making the Fed increase rates more slowly than they would had this not be, if this weren't currently happening. If there was no war right now, the Fed would have ramped up rates even higher and would have announced a much faster than $100 billion a month tapering, which is pretty fucking quick, but it's nowhere near fast enough. They got $9 trillion. If you're losing $100 billion, or say selling off $100 billion a month and not buying anything at all, gee, it would take 10 months to pay off $1 trillion. You multiply that by 9, and you're looking at over 8 years in tapering. The Fed can't taper for 8 years before the economy collapses. The economy is already collapsing. We're already in a recession. You just haven't realized it yet. You just haven't realized it yet. Look at inflation. This does not happen during times of economic strength. Period. This I completely disagree with. Bullard said that markets have already incorporated Fed tightening into their pricing, with the 2-year Treasury yield trading at around 2.45, 1 percentage point below what might be needed. Anybody telling you that this is priced in is lying to you, if they're aware of what's happening, or they're unaware of what's happening. This is not priced in. Evergrande and Chinese developers collapsing is not priced in. Fed tightening and tapering and selling off $100 billion is not priced in.
You know what I seen it.
Yeah, brother. Look at the federal funds rate. What a joke. And the implied path of the market and the Fed projected path. Yeah, I'll believe that when I see it. E-mini S&P futures. Well, gee, would you look at that? E-mini futures today, we're up at a high of almost 44.97 and managed to hit a low of 44.63. Remember what happened in January? You know, the way the market was crashing? Get ready for that to happen again in overdrive. I'll be sure to cover it if I can. Who wants to see some AMC and GameStop executive orders, though? Honey, can you chill out, dog? What is your problem? Fucking bitch. Oh, look, it's the devil. Check this out, guys. You want executive orders? I got executive orders. That shit's gonna get you. That shit should get you pumped. Because I don't know what the fuck else is more pumped. Gets me more pumped right now. Nothing. Now, as I'm pulling these up, remember one thing. What gives me confidence that the banks and Blackrock and Vanguard and all these other cats are actually going to pay us? This guy here used to work for the Federal Reserve as a Fed banker. He told us on many occasions, I believe his name is Joseph, I can't remember his last name, told us specifically that the Fed is too big to fail. They're like the power company. They're too big to fail. It is impossible that the government will allow them to fail. The government will bail out these banks to pay us. Knock on wood. And again, I'm not a financial advisor. Nobody can see the future, but you got to read the writing on the wall. My mic is very low today. I don't know. What do you guys think? I'm here. I think my mic is got some good volume.
I have to have my headphones in to hear you.
Oh, yeah? All right, cool. Thanks for the heads up. Let me turn that shit up.
No worries, mate.
All right, good deal. How's that, people? A little better? There you go. Got some gain going. That should help out a lot. All right, thanks a lot, Domini. I just tried to turn it up a little bit. That should be a little bit better. Look at jet fuel price developments.
Fuck, boy.
Oil. Yeah, brother. What do we have here? Washington, D.C. Executive Order 13959 of November 12, 2020, addressing the threat from securities investments that finance communist Chinese military companies. That caused all that collateral to become completely worthless through January 28th. Look at that. We all know what happened on January 28th, right? And that was extended through May 27th. Right here on an extension of that same Executive Order 13959, amended by Executive Order 13974 on January 13th, 2021. However, it was implemented after the fact. And that caused a subsection 4A of Executive Order 13959 to be amended, authorized through 9:30 a.m. Eastern Daylight Time, May 27th, 2021. For those of you that are unaware, May 27th was the beginning of it. A few days prior to May 27th, AMC and GameStop started running upwards again. And on June 2nd, AMC got to an all-time high of $79 and change and ended the day around $72. Here is another executive order, 14032 of June 3rd, 2021. This is the executive order that made amendments to Executive Order 13959 of November 12, 2020. And what this did on this document of 30,149 pages, 5 pages specifically for this part, it extended that collateral on June 3rd, the day that AMC started going from 72 down to 52, because it was the market makers and hedge funds and prime brokers and banks got their collateral back. They got all this Chinese military company collateral to be effective again as of 12:01 a.m. Eastern Daylight Time on June 3rd, 2021. They gave a 365-day extension through 12:01 a.m. Eastern Daylight Time on this June 3rd, 2022, with respect to the purchase or sale of publicly traded securities described in the subsections above, made solely to effect the divestment of such securities by United States persons. That means that all this collateral is permitted prior to and through 12:01 a.m. Eastern Daylight Time, June 3rd, 2022. Therefore, all of this Chinese military company collateral will once again be completely fucking worthless. And Janet Yellen on February 15th, 2022 added regulations to implement this executive order related to these investments as amended by the June 3rd, 2021 executive order related to the Chinese military industrial complex executive orders. They are now available and it will take effect upon publication when this occurred on the Federal Register February 16th, 2022. They added on many more companies and they published an amendment to that executive order for the weapons of mass destruction, proliferation, sanctions. You guys remember WMDs? George Bush, 9/11? I won't even go into the details, but you should know. And if you still believe that cave-dwelling fucking terrorists did what they did, I think you need to look into it a little bit more. These companies were added. It's hard to read. Sorry, I took a screenshot of my phone at the time to that collateral. And I've got an update for you from my guy who helped me get this, who helped show me this information in the first place. Let me go over to my Twitter messages and I will pull up the information on the Chinese military collateral updates. And remember, I showed you guys in the Twitter that Blackrock offloaded $370 million of this shit collateral last month. For the first time. They're finally starting to fucking try to unload it. Finally. It's kind of the point where I have the utmost confidence in what is going on here in the situation, and it feels absolutely fucking great. So again, this was another one, 13959 amendment that occurred that authorized this through June 11th at that time. Executive Order 13974 was amended on January 13th. 13959 defined certain subsections were amended through June 11th. So there are a lot of moving parts here, as my man Chael Sonnen likes to say. There's a lot of moving parts. However, you can see that they added companies on January 8th, such as China Mobile Limited, China Telecom Corp, China Unicom Limited, etc. These are the same types of mobile carriers that have been banned from owning certain areas of land and cell phone towers here in the United States. These same carriers have bought up all of the mobile cell phone towers surrounding United States military bases, because although they cannot see or hear what they're discussing, they know exactly to who exactly they're calling and texting, and for what period of time and when. So there's so many things that are happening here. This article was from the Financial Times, and it shows you that U.S. listed Vanguard FTSE Emerging Markets Exchange Traded Fund, that's just one, had $71.69 billion in assets January 6th, of which 43% had an exposure to the Chinese market. BlackRock's Emerging Markets ETF had about $70 billion in assets and an exposure of 36% to the Chinese market. The Vanguard Total International Stock Index Fund tracks more than 7,000 stocks and had $400 billion in assets, one of the largest fund allocators to 4 of the blacklisted firms. And they told us specifically, where's it at? Vanguard said specifically, since the executive order was first announced, we've been keeping our client-facing associates prepared with a response for inquiries on the topic. In short, Vanguard will fully comply with the executive order and will continue to monitor the situation. Vanguard will do whatever the United States government allows them to at any moment, but will comply because they know that at the end of the day they will get bailed out. All right, where's that?
You mean whatever they tell the government to do?
Exactly, because we all know that the Fed and the Fed presidents control the goddamn government and not the other way around. I would like to give a big shout out to my man Asleep No Longer at Bias FAC. Follow him on Twitter. He helped me figure this out. Well, he helped show me the very first executive order that kind of got my whole brain trying to turn and figure out what's going on here. And that really helped a lot. You know, take a look at this. He posted this again, December 7th, 2021. We've been talking about this for a while. Thankfully, he put me onto it, and I can share it with you all. So make sure you guys are following at Bias FAC on Twitter. Transactions were authorized until January 28th, the day the buy button was turned off, as explained, right? On January 26th, another document was released updating the effective date to May 27th. However, by then it was too late. So many of these guys had already started buying into and buying back securities on January 26th through that date that even though it was extended through May 27th, the reverberations that were caused and the FOMO that was caused by deep fucking value having to go to court and testify in front of Congress caused things to get out of control. The options that people buy, the call contracts that we buy, actually helps make the squeeze happen. I'm not a financial advisor, but that is the way market mechanics work. The more people that buy calls on AMC and GameStop, the higher the price will go, because market makers sell you naked calls. But they do have to be hedged for, especially when their collateral is worthless, margin call defaults are taking place, and they got to start buying back and delta hedging and covering their naked fucking calls. And then what the fuck happens, Cash? What the fuck happens when they start hedging? The goddamn money printer comes out. You remember it in January if you were there. You remember it in July if you were there. May and June if you were there. And it's going to fucking come and happen again. June 3rd, 2022. I bet a few weeks before then, you're going to see the price going up. Why do you think I didn't give a shit that the price went up 35 or 40% last week or 2 weeks ago for AMC? Why do you think I put out a video telling you guys, hey, this is not the fucking squeeze, guys. Let me get a couple more 40% days, then we could talk. But one 40% day is nothing. other than moving up in a channel, other than some slight short squeezing and some very tiny FOMO happening with Highcroft mining, a little bit of short squeezing there that's bleeding over to the other products, exchange traded products in the same basket, like AMC and GameStop, and then all the smaller ones like BBIG and MMAT and so on, and Sundial and Tilray, who combined with the things that were happening regarding the legalization of marijuana also helped push that little short squeeze throughout the ETF markets. And that's what led to the price increases. Now that we're seeing realistic price action on the stock market and the market's coming back down, you can expect AMC and GameStop to be shorted to fucking shit before it goes back up. But I'm more than happy with that, because the lower the price goes, the more fucking call contracts I get to go. I get to fucking pick up, and I am going to exercise. I'm going to sell some of them, and I'm going to exercise a shitload of fucking contracts as the price is squeezing. And I will be happy. Cash and I will be happy to single-handedly contribute six-figure shares, squeezing and exercising into this motherfucker. I will be more than happy to watch that fucking happen, and I'd be more than happy to fucking post it up on this video and maybe even throw my accounts on the screen here while it's happening. Again, I'm not a financial advisor. This is not financial advice. This is for educational and entertainment purposes only. You should take everything that I say with a grain of salt. Do your own fucking due diligence. At the peak of GameStop, thank you. At the peak of GameStop and AMC price, Biden amended the executive order on June 3rd, delaying the effective date to June 3rd, 2022. Be careful, because the next EO could cause a run-up at any moment. And he's absolutely fucking right. He's absolutely fucking right, 110%. Awesome, awesome, awesome all around, dude. You are the fucking man. I thought I shared this already. I think
we're gonna be so rich. My executive order.
Isn't it funny when the fucking president of the United States is trying to fuck other countries, is gonna fuck the majority of Americans at the same time out of their stock market and investments, equities, bonds, 401ks, IRAs. And in the meantime, the people that get to do the due diligence and actually look into what's happening are going to be filthy fucking rich. And I've had some people say recently that, you know, that they're concerned for my mental health and my well-being, and they believe that it is an obsession. And I hate to say it, but I don't mind being obsessed with something that I know is going to make me filthy fucking rich.
Well, look at the world right now. What's happening? Really?
Yeah. Do you have to be a fucking rocket scientist to figure out what's going on in our economy? How many of your fucking friends and family are unemployed? How many of them are working gigs doing Uber Eats and shit because their fucking regular nursing job pays them $17 an hour, or they can go make $25 an hour doing Uber Eats? Just fucking think a little bit. Who gives a shit you got a 3% fucking raise this year? Inflation's up 9%.
Yeah, Jeff, it went up tenfold.
Fuck. You guys know that the reason that I don't live stream more is because it's so clear that it aggravates the shit out of me. That so many people are unwilling to take the time to do the research, but are very quick to put your research down because it doesn't make them feel good inside to think about.
Yeah, man, people do not like bad news, even if it's the truth.
Let's see. Jonathan Garcia asks, when trades? To be honest with you, probably never. I've reached out to him many times. It's gotten tons of feedback from people on Twitter and the community, and they all want to see Trey and I and AMC Bigums have a three-way discussion. But Trey doesn't want that because, let's be honest, he'll be outclassed. Trey's a hype man. I love the guy. He helped me during hard times when I was figuring out what the fuck was going on with AMC and GameStop. But and I hope all but the best for him. All the best for him, for Trey. I just don't think the guy really knows what the fuck he's talking about as far as the intricacies of the market beyond the short squeeze. He may know a little or quite a bit about AMC short squeeze, and I applaud him for that. But I think he's way outclassed when it comes to due diligence and research.
He's a great trader and we love him. But
Absolutely.
he's no economist.
No, absolutely not. And I'm not an economist either. I'm just a business owner, an entrepreneur, a stock market investor, a former real estate broker that has been investing in the markets for a long time, that remembers what 2008 was like. I don't think Trey does. You know, Trey's in his early 20s. I highly doubt he remembers 2008 the way that we do. And this is the exact same thing that most people don't realize. Everybody thinks that's past us, that the financial collapse is behind us, but it's not. It's not. It was the biggest can kick, as annoying as that fucking term is. It was a punt by the Federal Reserve of the United States government. And here we are. That ball has landed. It's bounced. It didn't even make it to the fucking field goal post. That shit bounced off, hit the ground, and is now rolling backwards. It's a downhill, slippery slope from here. Because when you over leverage the market to 1.4 quadrillion,
Yeah, that they've admitted to. Probably more.
that they've admitted to.
We'll probably find another quadrillion after all for ya.
Yep. This is the Office of the Comptroller of the Currency, second quarter 2021 report. Let me pull up the more recent one for you. This is the current issue for the fourth quarter. This is the most recently available, okay? They're always released a quarter behind because we just finished the first quarter of 2022, so that's not yet out. Trading revenue in the fourth quarter was up for banks in the fourth quarter of 2021 compared to the fourth quarter of 2020. What does this also mean? That 4 large banks hold almost 90% of the total banking industry notional amount of derivatives out of 1,306 insured U.S. national and state commercial banks and savings associations that held derivatives. That means 4% of these banks hold almost 90% of all of the liabilities.
Yeah, I bet you can guess who.
Derivative contracts remained concentrated interest rate products, which represented 71% of total derivative notional amounts. Mortgage-backed securities, reverse repurchase program bullshit, credit default swaps. Sound familiar? Michael Burry told us in 2008. Everybody thought he was crazy too, until it actually happened. Ain't it funny the way that works out either? Also, huh? And for those of you that aren't aware, centrally cleared derivatives means things that are traded on lit markets. Anything traded on lit markets does not go through a dark pool. 39% in the fourth quarter of 2021 was traded on lit markets. The other 61% was traded on dark pools. It's really simple. All right, well, let me see. I thought I turned down my volume, but apparently not. There we go. If it's not my customer, it's not important. Not important. Fuck off. All right, yo, thanks so much, Boom Boom Power. I appreciate your support, brother. You know what? I will check out European MPI. The Migration Policy Institute Europe. Really? What is it you want me to check out?
Man, you were smart about the derivatives, though.
The derivatives are fucking nasty.
You're the only one covering them on the AMC.
And nobody understands what the fuck it means. Nobody understands that this is what matters. And they're all pretending like it's just gonna fucking
their heads.
Again, released March 2022. Office of the Comptroller of the Currency. Let's just take a quick look. Think of the information that you get when you just bother to look for it. This is the 105th edition. Net current credit exposure decreased 97 billion. That doesn't say much when you have $426 trillion in derivatives. But they did manage to get it down by about $7 trillion. That's why before I used to say 430 trillion. Now I say 423 trillion. I think I made a mistake. I said 426 a minute ago. Check out this change. Year over year percentage change. See foreign exchange? There's been a 20,000. Oh shit, can you see that on the screen? Let me see. Not really. Let me move it over. There's been a 20,000% increase in Forex trading revenue. Quarter over quarter. See that? 20,417% increase. Holding company trading revenue was $56 million lower than in the previous quarter, primarily due to decreases in revenue from Forex, commodity, and credit trading instruments. Year over year, get this, guys. Do you want to know right now why the United States banks had more money as far as their trading revenue? Because they moved it from their offshore overseas holding companies here to the States. That's why their year over year holding company trading revenue decreased by $3.9 billion, 21.6%. They're not making more money. They just brought money in from overseas, from their offshore bullshit that they used to abuse and get around the Dodd-Frank Act regulations. What continues to go up? Forex trading revenue is up 815% year over year for them. So 21,000% for the United States banks and 800% increase for their offshore holding companies. Look at the bank trading revenue as a percentage of consolidated. And they even tell us here that now typically trading revenue has fallen between 30 and 50%. This decline reflects the significant amount of trading activity by former investment banks that remain outside insured commercial banks. Now they have more limited legal authorities here in the United States than their holding companies. As I said, they sent shit off overseas to trade the same mortgage-backed securities, tranches of bullshit that your money was invested in 2008 and is invested in right fucking now. Do me a favor, if you learned something or are interested in learning more, subscribe. If you already knew this information, please drop a like. It's good for the channel, and it helps share this information with other people. Because in the meanwhile, there's hundreds of thousands of people out there watching videos on AMC and GameStop that have no fucking idea what is actually happening. And I feel like those of us in the Discord think tank here on YouTube and on Twitter have a much better grasp than the majority of apes, because it's very hard to get traction on a platform like YouTube. And my only real purpose for being here is to share this information with people. So if you would do me a favor, drop a fucking like, share it if you can on Reddit, Twitter, fucking LinkedIn, whatever the hell you want. Counterparty credit risk is a significant risk in bank derivative trading activities. What does that mean? That when hedge funds collapse, the counterparty risk is huge. Given to you directly from the quarterly derivatives report, fourth quarter 2021, from the Office of the Comptroller of the Currency. This includes the notional amount of derivative contract. It's a reference number that determines contractual payments, but is generally not an amount at risk. Okay? Now, this doesn't mean that they could lose every dollar. They could lose that dollar and then some. They have something called, it's slipping my mind right now. The way that these banks trade and rehypothecate amongst each other, they're basically trading a package of bullshit here with another package of cow shit here, and saying, thank you. If both of these that are held against each other, the counterparty risk would only be about $100, even though we've got about $1 million worth of risk here. And that's the way that they cook books, to make it seem like they've got less risk than they actually do. However, when markets collapse, then all of that other counterparty risk, that other counterparty assets are also worthless, making all of the risk come into play. It turns notional amounts into real fucking figures.
Yeah, it's like Groundhog Day in no way.
And they're telling us right here, credit risk in derivatives differs from credit risk in loans because of the more uncertain nature of the potential credit exposure. Because of the rehypothecations, and that means trading the same things over and over again, there's more risk than is actually known. I can sell you a derivative product that's based off of these two things, off of these two mugs, and that's one product. Now I'll sell you another product that's based off of these two. That's another product. Now let's sell you another product that's based off of these three products. That's another product. But what happens if any one of these goes collapse? All those exchange traded products become worthless. Do you understand the way that this Jenga game of tranches works? The credit exposure is bilateral in most derivative transactions, such as swaps. Each party to the contract may and probably will have a credit exposure to the other party at various times during the contract's life. The amount of risk is the amount advanced to the borrower. The credit risk is unilateral as the bank faces the credit exposure of the borrower. Both of them are fucked if the other defaults. Simple. Let's go here. Read this. You need to know this. The total of all contracts with a negative value, payables to the bank, is the gross negative fair value and represents a measurement of the exposure that the bank poses to both counterparties. Gross positive fair value, on the other hand, is the derivative's receivables to the bank and represents an initial measurement of credit exposure. Okay, the credit exposure decreased by about 6% in the fourth quarter, and the derivatives, primarily driven by a 7.3% decrease in receivables from interest rate contracts. Swaps and such are also making less money.
And the counterparty risk has never been higher.
Exactly.
Or more toxic.
Exactly. And again, I've been looking at these same stupid reports for like a decade. And I never thought they were important.
No one in human history have ever seen shit like this. This never happened ever. We're in uncharted waters. God help us.
Yeah. So again, this is the same way they're using what's called net setting. All right. So when they have these agreements, they can take these 6 contracts worth $500, these 4 contracts with a negative value of negative $350, and they say that these 10 contracts are worth only $150. This is the way that they cook their books in order to make everything look kosher and trade derivative products against each other. You could say it's a hedge, but there's not always a direct hedge. Same thing with AMC and GameStop. Ken Griffin could spend all the remaining money that Citadel has on calls for AMC and GameStop, but when they start buying back their short positions, it's still not going to be enough. Even if they made a fucking few $trillion, or few billion, let's just say some realistic number, it would still not be enough to cover their tens of billions and, I'm sorry, 57 billion supposedly in shorts sold and not yet bought back. That's per Citadel's most recent fucking reports. It's the same thing here. And then when Citadel collapses, who do you think their prime brokers are? JP Morgan, Bank of America, and Goldman Sachs, amongst others. Net current credit exposure in billions of dollars. It was at 804 billion in 08, and it's currently at 356. The only reason it's collapsed here is because in 2020, as it was on its way right back up to where it was, we had that little thing called, COVID that shut down the stock markets and brought that down to not just a tiny bit here. The bulk of the financial system of the NCC is concentrated in banks and securities firms and corporations. The combined exposure to hedge funds and sovereign governments was small, 9.4% in total. That's still pretty large when you think about the trillions of dollars being traded. You scroll down to the meat and potatoes here. That's my girl right there. All right. Derivative notional amounts by underlying risk exposure quarter over quarter. What does this tell you right here very clearly? The risk exposure in interest rate products is up 8.8% year over year, 5.7% in FX, foreign exchange, 12.8% in the equities and stock market, 13.6% exposure in these derivatives to commodities and naked shorting things like silver and gold. And then 16.7% in credit derivatives.
Massive collusion.
Massive collusion. Contracts by type, swaps are up 13%. Why? Because those ISDA, different kind of ISDA swaps can be used to manipulate stocks and to be able to kick the can on failures to deliver. Plain and simple. The most obvious answer is usually the right answer. Centrally cleared derivatives. Look at this. FX. That's foreign exchange. Only 2% or less of Forex of the fiat is being traded on lit markets. Do you understand that the US dollar and all these other fiat are being artificially manipulated now? Because even AMC and GameStop get at least 30%, 35% on a daily basis or yearly basis of lit market trading. But Forex, not even 2%. Look at precious metals. You think silver and gold and palladium and platinum are not being suppressed? They're traded almost 97, 98% on dark pools. That means price distortion. There's no price discovery. They can trade it at whatever price they want and you'll never see it. The price will never go up. That's why physical commodities, tangible, physical tangible items such as silver and gold are extremely important right now. There will be a silver and gold squeeze. It's the everything bubble. and it's the everything squeeze. Bilateral netting. That's the term I was looking for earlier, as we discussed with the netting agreements. Oh, look, numbers. Ain't that nice? Look at that. JP Morgan Chase. They have $3.3 trillion in assets, but almost $50 trillion in derivatives. Sorry, I know if you see this and you says, oh, that says 49 million. Yeah, this table is expressed in millions of dollars. So you got to multiply 49 million times a million. All right. What does that tell you? JP Morgan at number one, $3.3 trillion in assets, $49 trillion. Let's just say 50 trillion in derivatives, $281 billion in risk-based capital, $165 billion, which is bilaterally netted. Gee, potential future exposure, another $237 billion, and total credit exposure from all contractors, $403. I wonder how much of it are shorts marked as long, or failures to deliver, or shorts that have been sold that have not yet been purchased. Let's take a look at our guys at Goldman Sachs. What does Goldman have? Goldman has a measly $434 billion in assets and $48 trillion in total fucking derivatives. Come on, people. You gotta be a fucking genius to figure out that when the markets collapse, these derivatives are gonna become pretty much worthless.
Infinite losses,
Infinite losses. When you short sell, you could have infinite losses. When you go long, you can only lose your initial investment. Why do you think hedgies and market makers that have gone short are fucked? Same for the prime brokers right here, like Bank of America and Citibank. Look at these fucking pricks. 1.6 trillion for Citibank with $42 trillion in derivatives. And I could just go on and on and on. But here, let's just go with the top four. We got Bank of America with $2.5 trillion in assets and $18 trillion in derivatives. But guess what? That's not all. That's just here in the United States. You want to see what their holding companies offshore hold? Oh, well, still, let's just add it up here. The top 25 here, they have $14.7 trillion in assets, but $176.4 trillion in total derivatives. Let's take a look at their holding companies. Excuse me. These gross fair values of derivative contracts. Let me keep going. I may have passed it. I might have to go up. I think I did. I'll go to above it. Here's their top 25 holding companies in derivatives. Now you got JP Morgan Chase. You can tell this is a different legal entity identifier. That you've got to add this as well. Here they've got another 3.7 trillion in assets and another $49.2 trillion in total derivatives that have no ability to be governed or overseen by the SEC, because the top 25 all these holding companies are overseen by the Commodities Futures Trading Commission, the crook by the name of Rostin Behnam, whose boss recently left the CFTC to go become one of the top guys at Citadel Securities.
And the other commissioner got the very stuff left because it was so corrupt.
That's a fucking shame, isn't it? Look at this. What do we have here? The Commodities Future and Trading Commission regulates the United States derivative markets, which includes future swaps and certain kind of options. Current acting chairman is Rostin Behnam. Also, on swaps, the SEC has no authority. The CFTC has jurisdiction on that, and they are in jurisdiction of everything overseas as well. They regulate the U.S. derivatives markets, futures, swaps, and certain kinds of options. The current acting chairman is Rostin Behnam. He was assumed office January 21st, 2021. He was preceded by Heath Tarbert. Who's Heath Tarbert? It's this fucking piece of shit. And this fucking asshole. See, you can make sure you got his face on there so you can see him. Yeah, there you go. This fucking asshole worked with Rostin Behnam at the CFTC. Heath Price Tarbert is an American lawyer and former government official who most recently served as the 14th chairman and commissioner of the CFTC. He also served as the Assistant Secretary of the Treasury for International Markets under Secretary of the Treasury for International Affairs. As of April 6th, 2021, he is the Chief Legal Officer of Citadel Securities. So these are the guys that we got to deal with over here, you know, and they're all working together to keep this shit going. Penny, come here, girl. Come on, come here. You're fine. Come on. Look at these numbers. Look at over here. Even Mizuho Americas. Look at how bad this is. 47, not even billion, but 47 million in assets, but $6.6 trillion in total derivatives. What do you think is going to happen to these fucking companies? You got HSBC, who is a known short and has committed so many crimes, but is known to be short on AMC and GameStop, as well as State Street Bank, Bank of New York Mellon, who backs Citadel Securities and many other companies. You know, you got JP Morgan and Goldman Sachs. All these fucking crooks are shorting the shit out of the markets. And they've only got, you know, let's say HSBC, for example, has $239 billion available in assets, but $3.5 trillion in market exposure, in derivatives, actually. But they've got $292 billion worth of total futures exposure, even more than they've got in assets. Another $739 billion in total options, and another $477 billion in forwards and over-the-counter. Okay, total swaps of $1.96 trillion. Over-the-counter. Derivative, credit derivatives, spot FX, $34 million. Ridiculous amounts of over-leveraging is fucking happening here. But you can't fucking get a car loan or a mortgage unless you've got phenomenal credit and can't over-leverage yourself very far.
Who would let them do this ever? Why?
Thorblader, thank you very much for your support, man. You're a real
Can we be over leverage $1 billion to 1? How about infinity?
Yeah. Look at this top 4 commercial banks right here. 7.9 billion in assets. Sorry, 7.9 trillion with $158 trillion in total derivatives. You know, it's a fucking joke, man. So if you're not concerned, I think you don't understand, or you just don't fucking care. I'm not sure. You know, this data not reported. Fucking scumbags. Credit derivative peak of 08. It's not looking much better, is it? This was 2008 right here. The credit derivative peak. Come on, pop up for me. Figure 7 shows the total notional amount of derivative contracts held by banks in the fourth quarter decreased by $7 trillion. However, it's still way fucking higher than it was here in 2008. We are now here. Okay, great. So they unwound a little bit of bullshit that didn't do any fucking good for them. Any good. Derivative contracts by product, type, everything. Look at how much they have in total notional derivatives, right? Almost $179 trillion worth. They've got about $110 trillion in swaps, equity return swaps, all sorts of things. You know, credit default swaps. Another $30 trillion in options, futures and forwards to the same tune. Look at what happened to the charge-offs from banks. These are all the charge-offs and recoveries from 2008 to 2010. And in the 2 years after 2008, the United States printed over $40 trillion in bailout money and gave it to banks and countries, actual world governments and central banks around the world. Secretly. We only recently found out about this through a Freedom of Information Act request filed by Glenn Beck and his team over at Blaze Productions. It is amazing. Amazing.
Yeah, what they doing secretly right now?
You see this green spike? Remember what I told you guys about September 17th? These are the charge-offs. September 17th, 2019, so many banks lost money because the reverse repurchase program imploding. Cost to borrow went from 0.05 to 11%. Federal Reserve had to step in, bail them out, print money. It imploded. And if they hadn't, and this shot up here from just from that one day, it shot up from fucking zero practically to almost 1,000 millions. So that would be, shit, how much is 1,000 millions, Cash? $1 billion? You know? $1 billion.
$1 billion.
In one fucking day, and it just kept ramping up. It ramped up for fucking 6 months, nearly 5 months, before it finally started to come back down. Remember what we had in 07, 08 with Lehman Brothers? This one's going to go off this chart. We're going to need to expand this chart to include, way higher than these, $4 billion in charge-offs that happen here. Figure 14 shows that bank holding companies and their reported 22.5 million in recoveries from derivatives in the fourth quarter of 2021. Over the past 20 years, the highest quarterly net charge-off for bank holding companies was 3.6 billion in the fourth quarter of 2010. And what was happening at that time? The Federal Reserve still printing 40 trillion fucking dollars to give to these banks. That's money that we have to fucking pay for through inflation, through taxes.
Yeah, that's why they did RRP.
Exactly. And every single day, the notional
They gotta
amounts,
give them money every day now. They're so fucked.
That's why the RRP is being abused so bad, because without it, the banks would have gone illiquid and the financial system would have completely collapsed already. Look at FX and gold in the bottom one is all-time highs. Banks are stocking up on it because they know that the fucking silver and gold and all these other precious metals are going to squeeze through the roof. Just like nickel. Nickel was no accident. No accident. Precious metal contracts by maturity. What does that tell you?
And they won't be able to reverse the trees this time.
No, they fucking won't. Because this isn't the fucking London Metals Exchange owned by Hong Kong. This is here in the States. I will definitely expect fuckery and manipulation, but it's going to squeeze one way or the other. 75 billion or 95.6% of precious metal contracts mature in less than 1 year. Only 4.4% of them mature in 1 to 5 years. What does this tell you? This tells you that
Derivative leases.
Derivative leases are off the chain. Off the chain. And they're using those leases to naked short the metals market. On that note,
Please.
Go ahead, Cash.
Please, man, please.
No, on that note, we're going to be fucking rich. If you don't get it by now, shit, I've been going for 1 hour and 28 minutes. If you don't get it by now, maybe this isn't the channel for you. Maybe you don't think it's going to happen. That's okay.
In summary, we're going to be so fucking rich.
That's it. There's no ifs, ands, or about it in my eyes. It's not an if, but it's a when. It's a when. And to those dumbasses saying that when's the market going to crash? Shit, the market did crash on January 26, 2022. And the plunge protection team came in and sold $50 billion worth of naked shorts on the volatility index in order to cause a gamma ramp on the S&P 500 and other equities within it. And volume traders had to eat it up because they had to take the other side of the trade and move along with it to make sure that they were staying profitable and hedging against their bets. That's what caused January 28th, 2 days later, because it's T+2 data, the United States Treasury failures to deliver to be at a 52-week high. Plain and fucking simple. The market's already crashed. They've bailed it out many times this year alone. And at some point, things are going to happen where nothing can fucking stop it. Nothing. So we're going to be fucking rich. That's all I fucking know. I'm not a financial advisor. I don't know about you, but I'm talking about Cash and I, and those of us in the Discord that are making our own moves individually. You know, no collusion of any sort. But I think people that are properly hedged in AMC, GameStop, and other good stocks, silvers and metals and things like that, are going to be filthy, stinking, fucking rich. And if you don't believe me, that's cool. I'll wave from the moon when we get there, and you probably won't see me because I'll be way too fucking high, theoretically and literally.
I can dig it, man.
We're gonna be so goddamn fucking rich. Holy shit. Thanks so much for your support, everybody. I appreciate you. I'll take more questions on the next one. But as of this one, I'm toast. My phone keeps fucking blowing up. I'm gonna have to get these calls. So I wish you
Yeah,
peace and
thanks
love.
everyone. Hit the like button on your web.
Thanks so much. Yeah, please like and share. If you already knew the information, but if this is something new to you, please subscribe. We're going to bring you a lot more. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. I want my fucking money.
You're an original,
hey,
aren't
yelling,
you?
Cowboy. Give me the fucking money. Get the goddamn money printer out.
Great.
Fucking rich. Get the goddamn money printer out. Gonna be so goddamn rich.
I think it's time to blow this scene. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich.